The problem is that the way Bush has done it over the last 8 years is to take out a credit card from the Bank of China in the name of our children, driving up our national debt from $5 trillion for the first 42 presidents. Number 43 added $4 trillion by his lonesome, so that we now have over $9 trillion of debt that we are going to have to pay back. $30,000 for every man, woman, and child. That's irresponsible. It's unpatriotic. That's irresponsible. It's unpatriotic. That's irresponsible. It's unpatriotic.
But I want to announce that the leaders of both parties in both chambers have reached an agreement that will reduce the deficit and avoid default, a default that would have had a devastating effect on our economy. The first part of this agreement will cut about $1 trillion in spending over the next 10 years.
That's irresponsible. It's unpatriotic.
The biggest issues President Trump will be facing during his first year in office: the impending debt ceiling deadline. As has been proven in recent years, the market neglects this matter at its peril. This video, which is based on an article we recently published on SeekingAlpha.com and Nasdaq.com, will explore this issue to help us interpret what will happen next and its effects on our trading. This is Understanding the US Debt Ceiling, the looming showstopper. The debt ceiling, or debt limit, is the total amount of money the government is authorized to borrow to pay its legal obligations. This includes commitments such as social security benefits, Medicare, military expenditure, and interest payments on national debt. The US Constitution specifies that the power of the purse is entrusted to Congress. This gives it the ability to control spending and borrowing, therefore also making it responsible for authorizing bond sales made by the Treasury and assigning the total limit on this. The current obligations include approximately $13 trillion of debt owed to bondholders and $5 trillion of debt owed to government accounts such as Social Security and Medicare trust funds. The existing debt ceiling is set to expire on the 15th of March 2017. At which point an array of severely negative market effects will take place, as well as harmful impacts on the US reputation and confidence. To avoid this, the newly appointed Congress will be required to work immediately in Q1 2017 to increase the limit and avoid any potential disasters from taking place.
That holiday expires, the debt ceiling will freeze in at $20 trillion. It will then be law. It'll be a hard stop. The Treasury will have $200 billion roughly of cash. We're burning cash at a $75 billion a month rate. By summer, they'll be out of cash. We'll be in the mother of all debt ceiling crises. Everything will grind to a halt. I think we'll have a government shutdown. There will be no Obamacare repeal and replace. There will be no tax cut. There will be no infrastructure stimulus. There will be just one giant fiscal bloodbath over a debt ceiling that has to be increased, and no one wants to vote for it. Now, when the market begins to understand that is what's coming down the pike, and not this nirvana of, the second coming of Ronald Reagan. I think the bullish optimism, which is utterly unfounded at the moment, will dissipate very quickly. And then, and here's the second point, they are going to raise interest rates on March 15th. They have to.
Eventually, Congress agreed to extend the existing debt ceiling until the 15th of March 2017, an action that was labelled by many as kicking the can down the road. Unfortunately, the problem will now need to be addressed immediately by President Trump, although a similar solution is likely to take centre stage. Considering the promises Trump has made regarding public spending, this discussion will be a delicate matter and will determine how far Trump's plans for investment will go in his first term.
No, it's not going to be like 2008. We won't recover from this. There won't be a recovery the way there was in 2008, 9, and 10. It's actually my opinion that Trump was chosen as the chump by the Democrats, okay? That they did everything they could to make sure that he was the one that they had to face, and they're just floored that they lost. The powers that be at that top level, right? Everybody else is a good party faithful and believed the party line and so on, and they weren't part of the machinations going on at the top here. But the reason that they did that was that these guys are, okay, it's twofold. They thought they could avoid what we're going to face. These guys thought they could go another 8 years and not have any change.
However, as the new president is likely to enjoy the benefits of having at least a marginally more supportive Congress than President Obama, a deal seems to be somewhat more likely. Nevertheless, these discussions will not be without issue, and any compromises that are made may not be entirely to Trump's satisfaction considering his elaborate plans. A notable portion of influential Republicans have long been opposed to any increases in the debt limit without restrictive changes being made in the budget to curtail spending. Although President-elect Trump has not been explicit about his approach to the impending debt ceiling issue, his actions regarding his cabinet may provide a clue. In particular, his nomination of South Carolina Representative Mick Mulvaney for Director of the Office of Management and Budget is intriguing.
What's the chief driver of the debt?
The entitlement programs, Medicare, Medicaid, and Social Security.
Okay, the deficit and the debt are different things. Explain it very quickly, the difference between the deficit and the debt.
The deficit is this year's shortfalls between revenues and expenditures. The debt is the accumulation of deficits over the years.
The baby boom generation will be retiring en masse here. What happens to Medicare and Social Security over the next 25 years?
They go up.
Okay. In 1950, how many workers were there for every Social Security recipient?
I think 15, 16 at some point.
16. How many are there today?
3.
How many will there be in 20 years?
2.
How can 2 people do what 16 people used to do?
Short answer is that they can't.
Are we living longer or shorter?
Longer.
So we're living longer, there are fewer workers, and more people are retiring.
Those are the hard facts, yes, sir.
Will you tell President Trump that if he ignores that, he can never get us out of debt?
Yes, sir.
Will you tell him that the promise you made about Medicare and Social Security is going to lead to their demise if you don't change that promise?
Yes, sir.
Will you tell him that there's a bipartisan way to do this? It's been studied extensively without gutting the program but saving the program?
I'm familiar with that, yes, sir.
Yeah. Would you agree with me that for younger workers, they may have to work longer before they enter the program to save the program?
I've already told my children to prepare for exactly that.
Ronald Reagan and Tip O'Neill adjusted the age of retirement from 65 to 67 to save Social Security. Is that accurate?
That is true.
Do you think we need to look at adjusting the age yet again because we live longer?
I do, yes, sir.
Do you think people in my income level should get a subsidy to pay their Medicare bill?
I believe that Medicare benefits should and could be means tested.
If the limit is not increased by March 2017, which would be considered a fast turnaround based on recent similar events, the US would immediately be in violation of the debt ceiling. At this point, the Treasury will need to enact its extraordinary measures to avoid defaulting on its debt obligations. These extraordinary measures would include halting contributions to government pension funds and reassigning certain funds that are issued by state governments. This may give the Treasury additional room to manoeuvre until the middle of the summer, although any actions taken to delay payment defaults are likely to cause panic in the markets and concern from the public, as we witnessed during the fiscal cliff discussions and throughout 2013. In addition to this, if an agreement does not take place before March, the Treasury's cash balance will need to decrease dramatically. The resulting reduction in US Treasury bills being supplied to the market is likely to cause a further increase in volatility, therefore compounding any concern and investor troubles. While the market continues to experience exuberant optimism regarding US assets, it may be time to throw some caution to the wind and monitor the developments of this impending situation. It would be unwise to suggest preempting a correction and attempting to profit from a reversal of the post-Trump rally simply based on the expectation of difficult fiscal discussions taking place. After all, even if discussions did hit a stumbling block, as Keynes famously stated, the markets can stay irrational longer than you can stay solvent. However, it is certainly a situation and potential issue that any investor with exposure to the US should be keeping a close eye on in the coming months.
Has anything really changed about freedom in this country, having personal freedom? Do you see any differences as of yet?
No, I mean, nothing's fundamentally changed. I'm not a conspiracy theorist. I don't think there's any any kind of grand plan behind anything. I think it's just it's simple history and arithmetic. If you go back throughout essentially all known human history, we can go back thousands of years to the ancient Sumerians, the Romans, the Greeks, the French Bourbon monarchy. We can see essentially that anytime governments get too deeply into debt, it causes problems. They don't have a whole lot of options. They don't have a whole lot of solutions. Historically speaking, there's only a handful of ways that governments can get out of that mess. And one of the ways that they do that is essentially by coming up with ways to deprive people of their freedom, both in terms of their individual personal freedom as well as their economic freedom. So they impose capital controls. They do things like, confiscate people's money, civil asset forfeiture, all these sorts of things that we have already started to see over the last several years, not just in the United States, by the way, but worldwide. We saw, in 2013, the government of Cyprus just froze everybody's bank account just like that overnight. People went to bed one night and they thought everything was fine. They woke up the next morning and saw that their government had frozen them out of their entire life savings. We've seen this astonishing rise of civil asset forfeiture. We see just a mountain of regulations that have been passed, in any given year, even in the United States, and in what I kind of usually refer to tongue-in-cheek as, in the land of the free, where there's about 80,000 pages a year published of rules and regulations and so forth, each one of those governing everything from what you can and cannot put in your own body to how you're allowed to raise your own children to how you can, run a business, start a business, make money, be responsible for your own livelihood and prosperity. So nothing has fundamentally changed just because you change the player, but the game hasn't changed. The game is exactly the same as it's always been.
So the game hasn't really changed at all, is what you're saying. And these regulations and all these laws and everything that they come up with, are you saying that this shapes us into doing what the government wants? Well,
I mean, look, the government's $20 trillion in debt. So and that's just at a nominal level, right? I would encourage all of your listeners to go and actually you can look this up for yourself. If you're talking specifically about the U.S. government, you can look up. I would encourage you all to look at U.S. government financial statements. Just Google that, right? And you'll come to a page on the Treasury Department's website where every year the U.S. federal government releases financial statements, just like any big company does. Apple and Google and General Electric and so forth all have financial statements. The U.S. government does as well. Skip down to the balance sheet, and the U.S. government's own estimation, these guys are more than $60 trillion in the hole. So it goes even beyond sort of the 20 trillion in, quote, national debt. We're talking $60 trillion in the hole. And so again, when you have that kind of giant gaping financial hole to fill, and you have $60 trillion in sort of negative net liabilities, you don't have a lot of options. And so you start looking around and trying to figure out, well, what can we do? Well, the first thing they do is they just keep going deeper and deeper and deeper into debt. And they'll keep doing that as long as the bond market allows that to happen. But they also get involved in all kinds of other things. And we've seen, obviously, governments over time resorting to, epic levels of inflation. I mean, that just, conjure stories for the history books, and every other possibility they can to get their hands on the cash that they need. Almost invariably, I would also point out that when governments get too deeply into debt, and it's not a Republican issue or a Democrat issue. It's not an Obama issue or a Trump issue. It's an arithmetic issue. I mean, quite simply, the numbers just don't add up. When you don't have enough income to pay this mountain of expenses, I mean, they're at the point now where they could almost eliminate just about everything we think of as government. They could get rid of the national parks, and they could get rid of the Internal Revenue Service, and they could get rid of the FBI and Homeland Security. They still wouldn't collect enough money to pay interest on the debt, and the mandatory entitlement programs like Social Security and Medicare and so forth. So the only, the answers, again, it's a pretty limited playbook. It's, it's more debt, it's inflation, and the biggest one is default. They end up, they'll have to either default on their creditors, the people that have loaned them money, or they'll have to default on the obligations that they've made to their citizens. They're saying, sorry, guys, we've been telling you your entire life that Social Security is going to be there for you. Well, guess what? It's it's not going to happen. They're going to change the rules, and change the benefits and all these things because they just don't have the money. This is an arithmetic problem. It's not a political problem.
You're absolutely right. I mean, the numbers actually don't lie. And is this one of the reasons why interest rates have been kept so low? Not just here in the U.S., but we see out in Europe, they're in the negative territory, Japan, negative territory. Is this one of the reasons why they're keeping it so low and they're not letting the interest rates rise naturally?
Yeah, that's definitely an issue. Interest rates have stayed low. People talk about, interest rates are at historic lows. Well, let's take that in context. Interest rates aren't just at lows in sort of, modern U.S. financial history, or even lower than, all of U.S. history. We're talking interest rates are at the lowest levels they've been in 5,000 years of known human history. Okay, we can go back to the ancient Sumerians when they carved, they carved economic financial transactions on cuneiform tablets, and we can go back and see, what interest rates were thousands of years ago in ancient Egypt and in ancient Greece and so forth. Interest rates today are lower than they have been in 5,000 years of known human history. That's simply unsustainable. Interest rates are lower. You make less interest than even the official rate of inflation, which of course official rates of inflation are generally understated relative to what the actual street prices are. But even relative to official rates of inflation, you're losing money. This is what they call negative real interest rates. Again, this is a phenomenon that's just simply unsustainable, where putting money in a bank essentially guarantees that you're going to lose money when adjusted for inflation and of course tax as well. So these are, this is all very unsustainable. But you're right. It's a nice thing for a government to be able to continue to borrow money when interest rates are historic lows. But there's something that's even sort of more powerful than governments and even central banks, and quite frankly, that's the market itself. The government has its balance sheet and the central bank has its balance sheet, but you put the entire world together with all the big banks and bond market participants and so forth, and if they don't want to buy the debt anymore, they're not going to do that. And that that when you have a sort of a decrease in demand in the bond market, that's something that pushes up interest rates, and they can keep trying and keep putting these Band-Aid fixes on it, but in the long run, the bond market is more powerful than even the Federal Reserve, and that's the thing. We're already starting to see interest rates come up. We're starting to see, even the Fed is starting to raise rates. The bond market has been pushing rates up. I mean, just since the election of Donald Trump, there's been a substantial increase in interest rates. And if you factor the additional borrowing cost in to the interest payment to these governments, the United States government, the Japanese government, a lot of European governments that are drowning in debt and having to borrow money just to pay interest, that increased interest rate, is something that costs them a lot of money, and that's money that they don't have. That just exacerbates the problem because now they have to pay more interest, which they don't have, they can't afford. So they have to borrow even more money to pay more interest, which means they have to borrow even more money to pay more interest. And the worse their financial situation becomes, the more their balance sheet deteriorates, the higher those interest rates become, and so it's a problem that sort of continues to perpetuate itself and gets worse and worse. So that's we're starting to see signs that we're at the beginning of that cycle now.
So Trump right now, he came in, Obama handed off the economy. And, he said that, I'm handing Trump a fantastic economy. It's recovered. It's fantastic. It's strong. Trump comes into the White House and he says, I'm going to be spending a lot of money here for infrastructure. I'm going to, take the economy to the next level. Is there anything he can do at this point to help the economy? Because in one of his statements, he said the economy is a complete mess. So, I mean, if he's going to borrow more money, isn't this going to put us deeper into the hole?
Of course. And anytime, you borrow money, you go deeper into the hole. There are always better uses of spending and worse uses of spending. Sometimes you can borrow money and it can be an intelligent thing to do where you can get a positive return on investment. Sometimes you borrow money. In most cases, when the government borrows money, it's a negative value. It's a negative return on investment. If you go back and you look at, when Barack Obama came into office, the national debt was under $10 trillion. The guy doubled the debt. It's almost $20 trillion now. And you have to look at that and you say, okay, if you took $10 trillion in debt, $10 trillion in debt under the administration of Barack Obama, and supposedly that money was, dumped back into the economy and stimulus spending and all these sorts of things, shouldn't there be, if assuming, even just a basic break even, shouldn't there, if you borrow $10 trillion and put that into the economy, shouldn't there be at least $10 trillion added to the GDP over that same period of time? I mean, that's assuming that's assuming there's basically zero return on investment. That's just you took the 10 trillion, put it back in the economy, and you got the exact same 10 trillion. Well, that didn't happen. There was no $10 trillion. There was some economic growth, but the reality is that most of that, quote unquote investment that they dumped all this back into the economy, they lost most of it. It was squandered on, $2 billion websites that didn't work and all these sorts of things. And so that's, this is the sort of thing that happened when governments get a hold of, very large, chunks of money. But maybe Donald Trump is different. Here's a guy who's say what you want about Trump. The guy, he's a good real estate developer, if nothing else. Some people love him, some people hate him. But regardless, the one thing that, the facts are fairly clear. The guy knows how to develop real estate. So maybe they have maybe if they borrow money, they'll get some positive return on investment that exceeds the cost of capital. But, at the end of the day, that's the thing that they keep talking about is we're going to borrow even more money. And again, when you start borrowing more money, well, what happens? The demand for loans increases, the demand for those bonds increase, which means that the interest rates go up, and they keep pushing interest rates up. And the higher interest rates go, the more unsustainable the balance sheet becomes, the more in danger they become of having to take more and more drastic actions. And so look, anything is possible. Quantum physicists tell us that even spontaneous combustion is possible. So I'll never rule out the possibility that maybe benevolent space aliens show up and give us all free energy and wipe the debts away. But the reality is that there's probably very few ways out of this, if any. I've done the analysis myself. There's not a whole lot of variables here. We're talking about interest rates, inflation, so forth. If you really crunch the numbers, you see there's just not any way out for the federal government that doesn't involve some level of default, and that's an event that affects almost everyone on the planet worldwide, simply by virtue of the fact that the U.S. dollar is still the number one reserve currency in the world.
Now, you said Trump is excellent at developing real estate and building. He's also very good at bankruptcies.
Absolutely.
Handling defaults. And what you've been saying right now is that, we're heading to a point in time where, our debt load is going to be too big. It's probably too big right now, where, things are going to start rapidly falling apart. And maybe it's a plan by someone, I don't know, to have him in the White House to handle the default of the United States. Do you see that as a possibility, that's maybe why he's there?
I used to joke from the second he declared his candidacy, I used to joke that Donald Trump was the only person qualified to be president simply because he had declared bankruptcy so many times. He had defaulted on his debt so many times. And I said, when you're $20 trillion in debt, you want somebody who knows what he's doing. You want somebody who knows how to file the paperwork. This guy has experience. He knows what papers to file, when he wants to go into default. And the thing is, he's even talked about it, almost bragged about it. And he said, yeah, of course, default bankruptcy laws. I mean, I've used these to my advantage, defaulting and using the bankruptcy code in the United States is something that I've used to my advantage as a smart business decision, right? So you're talking about a guy that has absolutely no qualms about not paying his creditors. So who's the creditors of the United States? You've got a number of large bondholders who own U.S. debt. Frankly, the largest. Everybody talks about the Chinese and all that, but the Chinese are nothing compared to the Social Security trust funds. I mean, it's the past, present, and future Social Security recipients of the United States of America are far and away the largest owners of U.S. debt. And it's the funniest thing in the world to me when they, people talk about debt, and there's like this sort of this mantra that they just repeat over and over again. It's something that become almost as if through repetition it somehow becomes true, regardless of whether or not the facts add up. And one of the things they keep saying is the debt doesn't matter because we owe it to ourselves. And I look at that and I say, I'm sorry. Are you pretending that it's okay that if the U.S. government defaults on tens of millions of Social Security recipients, that's somehow not going to cause any problems? That's okay? Who else owns it? The Federal Reserve. So say, okay, you're going to default on the Central Bank of the United States, effectively rendering the central bank of the largest economy in the world insolvent overnight. And we're just going to pretend like that's okay, like that's not going to cause some massive currency crisis, massive loss of confidence in the U.S. dollar around the world instantly, that's just somehow going to pass without consequence. I mean, it's madness when you hear people say this stuff. So, what could he probably get away with? He could probably get away with defaulting on the Chinese. They'll find some reason and they'll go, oh, China's manipulating its currency. There's unfair trade practices, and then, we're going to default on the Chinese, because they're a bunch of SOBs. And so we're just going to default. And my guess is that if they did this selective default against the Chinese, that, of course, the Chinese would never, invest any money in the U.S. ever again, and it would cause a huge trade war, and there would be severe consequences. But that's probably the least bad option for them if they put all the options on the table and say, okay, let's completely destroy every current and future retiree. Obviously, that's going to cause massive problems domestically. We can default on the central bank. It's going to cause an extraordinary financial and monetary crisis, both in the U.S. and worldwide. Or we default on the Chinese, and okay, we'll just suffer the consequences of the impending trade war. That's probably the best solution for them. I would say the least worst solution is probably a better way to put it. And again, a guy that's done this so many times and thinks that it's a great business decision, I could absolutely see that as a possible outcome.
And China and Japan and Russia, they've been dumping treasuries, billions of dollars worth of treasuries. I know China has trillions worth of treasuries, and they've been dumping it and purchasing gold in its replacement. Is this their way of trying to get out of the U.S. paper market?
It certainly seems to be a trend. I wouldn't say dumping treasuries. I would say, trading them for anything they can get their hands on that's actually real, including gold. The Chinese have been doing this for a while. They essentially have been investing a lot of their surplus with the United States, their dollar surpluses, and been trying to. I've had a number of conversations with people that were inside, the Chinese sovereign wealth funds and so forth. People that were senior investment executives, and they were almost complaining. They said, we're sitting on so much cash, and U.S. dollar cash, and it's hard for them. They can't look at a deal unless it's billions of dollars, and it's a hard thing to find a credible deal that's worth billions of dollars, and gold is one of the only things that they can really get their hands on, that they can feel like, okay, there's a fairly steady supply, there's a market for it. We can, it's something that's useful, that's real, that's universally recognizable, it's safe. That's easier for them to buy gold than it is for them to go out and try and invest, 10, 15, $20 billion at a time. Because what else are they really going to do? They could try and buy, entire companies, for example. They could go out and try and take, buy tons of real estate and so forth. But they'd have to do that in places like the United States. They'd have to go out and make tender offers for large publicly traded companies. Could you imagine I mean, could you imagine the shitstorm if the Chinese sovereign wealth funds came over and tried to buy ExxonMobil, for example? I mean, that's an easy way for them to spend, hundreds of billions of dollars all in one fell swoop. But I mean, there's no way a deal like that would be allowed by the U.S. government. Could you imagine if the Chinese tried to buy Berkshire Hathaway from Warren Buffett? I mean, it's just not going to happen. Right. So or they just the Chinese come in and they start buying up, the Chinese sovereign wealth funds start buying up massive swaths of Manhattan, or South Florida or Los Angeles. I mean, these are the sorts of things where, these deals would either be disallowed or, so the properties could end up being confiscated back. This is too risky. It's too difficult for the Chinese. So, in the absence of, they've been buying as much as they possibly can. They've been buying farmland in Africa, and strategic assets like this that are real assets, not paper assets, but they have to get that money, in something where they can trade, U.S. dollars for some kind of strategic real asset. And, there's just not a whole lot of options for them. When if you've got $50 million to invest, it's great. The world is your oyster and there's tons of opportunities out there. When you have $2 trillion to invest, it's a really, really difficult thing to do. So there's not a whole lot of options for them. I think gold is clearly something we're going to continue to see that trend and probably see a lot of increased demand in gold, driven almost entirely by the Chinese. It'll happen, there'll be some sort of steady increase, and then, somebody will issue a report that we'll see the Chinese have been buying up, however many, tons of gold, and we'll see these, these big price swings where, overnight we'll see, very large increases to the gold price, very, very quickly. I think that's entirely feasible as well.
I wanted to get into different countries that are banning cash right now. We saw it in India. Europe is looking to ban the 500 euro. Here, Larry Summers is saying we should get rid of the $100 bill. Why is there such a push to get rid of cash? I mean, they're making the argument that, criminals use cash and that's why we have to get rid of it. But what's your take on this? Why are they pushing to get rid of cash?
Well, criminals also use toilets, so maybe we should get rid of those too. It's such a hollow argument. I mean, people that talk about this idea of, criminals use cash, ipso facto, we have to get rid of cash, have never been outside of their ivory towers at Harvard or Washington, D.C. They don't understand how the real world works. If they did, they would realize that, the biggest thing that people are using these days, in money laundering and these sorts of things staying off the radar, it's not even cash, nor is it, people say, oh, it's Bitcoin. No, it's not Bitcoin either. It's Amazon gift cards. That's what people are using. Amazon gift cards. Amazon gift cards are basically cash equivalents around the world. You can load them up at, drugstore chains, across the planet. I mean, it's, and then, people kind of do a double, money laundering where they go on to, they'll buy Amazon gift cards and then go onto Amazon and buy some other store's gift cards, and just use that to, to really mask where all the money comes from. I mean, these guys that talk about money laundering and cash, I mean, they just don't have the foggiest idea what they're talking about. Drug dealers and prostitutes take American Express. I mean, they just really don't have a clue. So of course they rely on that thing, because anytime you want to convince somebody of something, you just say criminals or terrorists or, something that's bad, and they scare people and they go, oh, well, okay. So some smart guy says that criminals and terrorists are using cash, so I guess we have to get rid of cash. And it's so easy to convince somebody. And of course, nobody questions it, right? Nobody questions it. It's like we're all living in some really bad movie from the 1980s or something like that. I mean, it's just the world has totally moved on from that. The reality is that, cash is something that they can't control. If you're sitting on a lot of cash, then they can't know what you're doing with it, where it's going, how you're spending it. But more importantly, cash is cash is money in your hand. Cash is something where you have now essentially eliminated counterparty risk. I remind my own audience as frequently as I can that anytime you deposit money in a bank, it's no longer your money. It's the bank's money, right? The bank puts it on its balance sheet as an asset. Now they have a liability to you. You become nothing more than an unsecured creditor of the bank. And the bank, if in its sole discretion, can freeze you out of your entire life savings without even giving you a courtesy heads up. And so if you look at it different risks in the banking system, ranging from all the nonsense we see, Wells Fargo, whatever, the sort of the compliance risks and the likelihood of being potentially frozen out of your savings. We can see different financial risks, razor thin levels of liquidity and capital, and a lot of banks, especially in Europe and so forth. You have to look at this and say, why am I taking on all this risk? What's the point? What am I getting in return? I'm getting 0.01% interest. Who cares? Why would I bother taking that kind of risk, right? And so the smart thing to do is to actually, short circuit that process, take money out of the bank, take money into your own hands, into your own safe and so forth. Now you don't have an intermediary. Now there's no middleman anymore between you and your money. Now you're no longer an unsecured creditor of the bank. Now it's just money sitting in your own safe. And especially, in places we've seen this in Europe where interest rates are negative, people actually, people with large accounts at banks are actually having to pay interest to the bank. There's a certain point where you go, wait a minute, why am I doing this anymore? This doesn't make any sense. Any rational person would just go down to the bank, close the account, take it all out in cash and just, keep it in a safe somewhere, put it, or just take it out and put it in the safety deposit box. But the reality is that if that happened, that almost every bank in the world would go under. If everybody went and tried to withdraw their money from the bank, no bank has that kind of liquidity. Banks are sitting on, as a percentage of customer deposits, banks have 1%, 2%, maybe 3%. That's actually in liquid cash. The rest of the stuff is all invested in who knows what, right? They buy loans. They invest in different swaps and different mortgage-backed securities and all kinds of stuff. And nobody really has a clue what banks are doing with their money. They give us these giant line items on their annual financial reports, but there's no detail, there's no transparency. But banks don't have the ability, if any meaningful percentage of the customers actually try to withdraw their money, the banks would all go under. And so in order to prevent that, it's certainly a nice, easy way of keeping the banks safe and solvent is just by telling people, hey, we're going to get rid of cash. That's only something for drug dealers, and criminal terrorists. And so that's, I think, a big reason behind it. It's certainly one of the banks are certainly, one of the biggest beneficiaries behind this. Banks hate cash. It's bad for them, and anytime people want to go and withdraw cash, it reduces the bank's profitability. It increases any liquidity risk and so forth. So that's certainly I think one of the measures behind it.
So do you think bail-ins are still in play? I mean, we saw it in Cyprus. The Greek people are very nervous about this. They've been taking their funds out of the bank, just like you're saying. Do you see the bail-in agenda still out there, and should we still be worried about the central bank and governments actually doing this?
Well, bail-in legislation already exists in so many places. They've formalized it in a number of countries. Even a place like Canada. This is all over the world now, where there's actually a clear framework for bail-ins. But I think it depends on the banking system, really. That's what it comes down to. There are certain banking systems that are, much safer, liquid, well capitalized, in a jurisdiction with no debt, backed by a central bank that's actually solvent and well capitalized, and has a well capitalized deposit insurance fund and so forth. So banking systems are not all created equal. There are massive differences between banking systems around the world. You point out Greece as well. Obviously, yeah, people are very suspicious in Greece and banking in their own system, and so there's been tremendous capital flight out of the Greek banking system, and this is something that's going to cause a number of bank failures in Greece. Again, it's not some grand prognostication. It's just a simple arithmetic problem that these banks simply don't have enough liquidity in order to be able to continue to withstand the withdrawals. There have already been some level of de facto bail-ins, especially across Europe, which has this, in my opinion, the sickest banking system. You look at Italy and even in France and so forth. It's just very sickly banking systems where they've had to impose some levels of capital controls. This is a de facto bail-in when you tell a depositor that you're only allowed to withdraw X, from your account, per week and so forth, and restricting what people are allowed to do with their own money. This is a form of this is clearly a capital control. It's a form of it's a bank bail-in light, essentially forcing you to keep your money in a bad system. And I think anywhere where you see those things happening, and people should be very concerned and really limit the the capital that they have in those kinds of systems. It's just not. Why are you taking the risk? You're getting 0.01% in return. I mean, the risk versus reward is just not there. It just doesn't stack up.
Yes, I agree with you. I mean, the risk of having your money in the bank is you're really not getting anything on your money. I mean, it's not really protected anymore like it was in the old days where you put it in the bank and they said, oh, don't worry, we're going to protect it from, thieves and robbery and things like that. But aren't all the banks now interconnected? So even if there's a banking problem, let's say in Europe, aren't they somehow, some way interconnected to the banks in the U.S.? Won't this have some type of domino effect if one bank starts to go down? I mean, is this
You're right, and
go ahead.
Yeah, you're absolutely right in that there's a great deal of interconnectivity in the banking system. And there are a lot of terms that came out of the financial crisis where we learned about intermediation and hypothecation and so forth. Essentially it boils down to the fact that there's a very large, strongly interconnected network. We saw this in particular in the United States, that with all these derivatives, for example, that with, when Lehman Brothers finally went under, that it was, it dragged down all these other banks with it, because, if Lehman Brothers is unable to pay its debts and goes under, and this goes for, over some bank in Europe or Japan or so forth, if all of a sudden there's a bank that's no longer able to pay its debts, then any other bank that's holding on to that bank's debt, now all of a sudden that asset is worth nothing, which means that now that bank might be insolvent because its asset, a big chunk of its assets just got wiped out and went to zero. And so now that bank might be insolvent, which means that any other bank that owns, that owns debt from that bank, might get wiped out. And so it creates this chain reaction where all these banks that are so interconnected with one another. And that's ultimately the nature of the financial system, is that it's all fine and good as long as everything else is working well. But as soon as there's a real problem somewhere, it can absolutely set off a chain reaction, and that's the risk. It's just fundamentally a question of where does that start. It's not an if question. I mean, we've seen this. It's absolutely foolish to just presume that, in light of all the evidence and all of the historical examples to show centuries of routine banking crises, and our species falling the same mistakes over and over again, it would be absolutely foolish to think that we can go this much into debt with interest rates this historically low, with this much interconnectivity, and just presume that that's just going to work out okay, and there's never going to be any consequence from it forever until the end of time. That's pure insanity. So it's ultimately just a question of when and with whom. Does it get started? Where does it kick off? Does it kick off? How does it kick off? Because Donald Trump decides to default on the Chinese? Is that what kicks it off? Or does it kick off because Greece decides to, finally once and for all leave the euro, and they have hyperinflation, and everybody with exposure to Greek debt, ends up becoming insolvent, and then every bank that has exposure to those banks becomes insolvent, and that sets it's impossible to know. All we can do and all we can see is that there is a lot of risk, and that any rational person has to look at that risk and say, there's a lot of financial risk. There's a lot of this counterparty connectivity risk. There's even just the basic, I would consider it asset protection risk, that at any given moment, the bank can just decide, oh, we're gonna freeze your account because, we think you've been doing something suspicious or something unusual or what. So, we're just going to restrict access to your funds. Or they're going to have capital controls that impose withdrawal restrictions, and all these sorts of things. And you look at all these risks and all these possibilities, and I think any rational person has to say, what is the point? What am I getting out of this? Very little, 0.01% interest. Right. It's just not worth it.
So Simon, from my last question here, you talked about, we don't know when this is going to be kicked off, where things start to fall apart. Now, when you say fall apart, are we talking about like 2008? What are we talking about here when things rapidly deteriorate? What are you seeing? I know you don't have a crystal ball, but what is the everyday person going to experience when this whole thing gets kicked off? We can talk about jobs. We can talk about what the economy is going to look like, what it's going to look like on the streets globally. What do you see coming?
I mean, look, there's a lot of things we could say. the banking sector and what we're talking about here is just one of the, it's just one of the issues. We have a banking sector issue where we can say, there's all this, interconnectedness among the banks, and there's so much intermediation, and there's, so many areas of concern. We've got the debt level. That's an entirely separate issue. And what happens, is interest rates continue to go up. Then we look at broader financial markets, and we can see, everybody's doing the happy dance because the Dow Jones Industrial Average, keeps soaring ever higher, and that's great. Except, again, if you start really looking at some of the fundamentals, I look at this stuff on a regular basis. One of the things that strikes me is so interesting. And this gets into some accounting nuances, but there's a big difference in companies between sort of profit and cash flow. Profit is sort of an accounting invention that takes into account all kinds of things that don't exist in the real world. And when I look at businesses, I always look at a company's cash flow, specifically, looking at its free cash flow and its operating cash flow. And the thing that I find so interesting is that there are so many companies right now. They're borrowing an enormous amount of money, and basically paying dividends out of money that they've borrowed. They're increasing the amount of debt on their balance sheet, and instead of investing that money in something that can grow the company, or again, there's good debt and bad debt. This is money that they're basically just borrowing cash and then paying all this cash out to the shareholders, or buying back stock or so forth. And so, talk about something that's completely unsustainable. They've basically engineered an artificial bubble in stocks that's driven on debt. And so all these companies are going deeper and deeper and deeper into debt, and all this stuff is, and using that debt to put money in people's pockets in a way that's artificial, because their businesses themselves, their cash flows are down, their operating cash flows are down, and yet we keep saying, oh, the stock market keeps going up. Again, it's artificial. They're engineering this sort of artificial increase in stock prices in a way that's just totally unsustainable. All these things all together, if you look at it, how sustainable is it that companies can continue borrowing money to inflate their stock prices? How sustainable is it that a government, the largest government in the world is simultaneously, the largest economy in the world is simultaneously the largest debtor in the world, that a government can continue to borrow money at historically low interest rates that are at the lowest levels in 5,000 years of known human history without any consequence? How sustainable is it that all these banks can be so interconnected and have razor thin levels of liquidity and questionable levels of solvency? All these things you have to look at and say, none of this stuff is sustainable. And, we can certainly hope that nothing happens. And sure, maybe nothing ever happens. Maybe it's all fine. Maybe it's all good. But the reality is that there's a lot of risk, and smart, rational people, especially if you're kind of financially minded, if you're an investor, in investment circles, we always talk about risk versus reward, right? And so that takes a very, sober, rational perspective, to forget about all the hype and all the emotion, just look at the facts. And then the facts, if you look at the data, if you look at the truth, you can see that there's a tremendous amount of risk, and say, okay, well, what's the reward? I get 0.01% in my bank, or I've got everything riding in the stock market on this artificial bubble. And okay, maybe it continues to go up. Okay, maybe you bang out another 5 or 10% or whatever. But are you willing to bet everything on this artificial stock bubble? You're willing to bet everything on this, this ridiculous interconnected system where, banks have the authority to basically take your money and make it their asset and no longer your asset, where you're become an unsecured creditor of a financial institution that might not even be solvent. And so, is this, you're taking on a lot of risk. Is it really worth the reward? Is it really worth the benefit? And I think a rational perspective would show that it's probably not worth it, because the consequences are, sure, we could see 2008 again. We could see something much worse. We could see something. It's to me, it's impossible to really say exactly how it pans out. But anytime there's a any kind of significant financial crisis, of course, there's always a loss of standard of living. There's job losses. There's, businesses go under, asset prices fall. We could see simultaneously. I would go back actually to the Asian financial crisis in the late 1990s. In Asia, they had actually the worst of all scenarios. They had asset prices fell. So if you owned real estate, if you owned stocks, all that stuff fell. But at the same time, retail prices went up, right? So you became less wealthy. You became essentially more poor, right? All your assets and everything was worth less, but you were paying more at the grocery store. You're paying more for food. You're paying more for healthcare and daycare and college tuition and whatever else. You're paying more, cost you more to live. But at the same time, businesses were cutting, and so you probably might lose your job, or you're getting, you had to take a pay cut. All this stuff was happening, simultaneously. You're getting asset price deflation, retail price inflation, economic stagnation, all this stuff all at the same time. And look, I'm by far not a doom and gloom kind of person. I'm talking about these risks and potential consequences, but I don't have a negative view on the world. I'm positive. I'm optimistic, and I think that wherever these risks are, I think there are also great opportunities, and it's all it really fundamentally takes, again, is that very rational view about what's happening in the world, and to seek out the right opportunities where the risk and reward stacks up, and that's really all there is to it.
If you have an opinion or any questions about this topic, leave a comment below. Let's continue the discussion. If you like the video, please give us a thumbs up, and make sure you subscribe to the channel for more videos like this and other lessons about our unique method of trading. Thanks a lot for watching, take care, and see you in the next video very soon.